let's jump right into this explainer, because we're unpacking a really fascinating reality of the modern tech world today. We're talking about how the machines that actually build our AI chips are having this massive, undeniable moment of their own. We'll be focusing specifically on Applied Materials and their seriously impressive Q2 2026 results. You know, everybody's talking about artificial intelligence right now, but you literally cannot have AI without the physical hardware. I'm talking about the advanced semiconductors running inside those massive data centers. And you can't have those semiconductors without the materials engineering solutions that Applied Materials provides. So today, we're going to look under the hood of, well, the engine that powers the AI engine.
Here's our roadmap for the explainer. First, we'll hit the AI infrastructure boom. Second, those record-breaking Q2 results. Third, navigating global market shifts. Fourth, powering sustainable growth. And we'll wrap up with number 5, the road to 2027.
Okay, Section 1, the AI infrastructure boom. To really grasp what's happening right now, this quote from CEO Gary Dickerson totally hits the nail on the head. He's highlighting how this explosive AI gold rush is directly translating into multi-year growth for the companies that are providing the essential picks and shovels. We aren't just talking about some short-term hype cycle here. We are looking at a sustained multi-year build-out of global computing infrastructure. As the whole world demands increasingly complex chips, the foundational engineering required to actually manufacture them becomes absolutely critical.
So what's driving all this momentum? It basically comes down to these 3 key pillars. They're hitting a critical inflection point because they hold leadership positions in the highest value areas. Think leading-edge logic, memory chips like DRAM, and advanced packaging. And get this, during their earnings call, leadership dropped a staggering statistic. Global AI token generation increased more than 3-fold in just 3 months. 3 times. That kind of exponential explosion in AI usage demands better, faster chips, which directly fuels the demand for Applied's manufacturing equipment.
Moving right along to Section 2, record-breaking Q2 results. Let's look at the numbers.
The crucial takeaway is right here, $7.91 billion in revenue, a new record. That is an 11% increase year over year, comfortably beating Wall Street's consensus expectations. When you have top-tier foundry logic and advanced packaging segments just firing on all cylinders to meet that AI demand, well, this is exactly the kind of top-line revenue growth it produces.
But revenue is only half the story, right? Comparing the GAAP and non-GAAP figures reveals incredibly strong underlying margins. Check out that 50% non-GAAP gross margin. That's actually their highest gross margin in over 25 years. Operating income jumped over 16% to $2.54 billion, and non-GAAP earnings per share rose 20% to $2.86. The big so what here is that they aren't just selling more equipment, they're capturing way more value and operating highly efficiently while they do it.
And of course, all that financial strength trickled right down to the shareholders. Operating with these kinds of margins means you're generating serious cash. $845 million from operations, to be exact. They distributed $765 million of that right back to shareholders through share repurchases and dividends. But the ultimate flex? It's that bullet point at the bottom. They raised their quarterly cash dividend by a very healthy 15%, which is a massive signal of management's confidence going forward.
All right, Section 3, navigating global market shifts.
Growth like this doesn't happen in a vacuum. Looking at their footprint, you can see it spans across North America, Europe, the Middle East, and Asia-Pacific. Operating a semiconductor equipment manufacturing business today is honestly a massive balancing act. You've got to navigate local market realities, intricate supply chain logistics, and ever-changing geopolitical trade dynamics. They're managing major manufacturing facilities in places like Austin, Texas, alongside critical sites in Singapore, Israel, and Taiwan.
And having that global footprint means you have to be highly agile. Right now, tougher U.S. export rules are causing a projected dip in China fab spending for 2026. But zooming out a bit, the company's CFO, Bryce Hill, expects overall demand to strengthen significantly in the latter half of the calendar year. So they're actively preparing their operations right now to catch that incoming wave of higher global demand, basically ensuring that short-term regional headwinds don't completely derail their long-term growth.
Which brings us to Section 4, powering sustainable growth.
Part of sustaining that growth means investing in physical infrastructure. Take a look at the new EPIC Center in Sunnyvale, California. It's an absolutely stunning facility, but it's way more than just a nice building. It's a specialized hub designed to accelerate the commercialization of next-generation semiconductor tech. By getting their partner engagements under one cutting-edge roof, Applied Materials is structurally positioning themselves to innovate much faster. They're literally side by side with customers solving high-value problems to drive the entire industry forward.
But true sustainability isn't just about buildings and tech. It's about environmental realities. Looking at their climate-related financial disclosures from their 2024 impact report, they acknowledge some very real physical risks. We're talking extreme weather in Southeast Asia and Israel, plus transition risks like higher compliance costs for processed gases. But, and this is a big but, there are huge transition opportunities here too. As the globe shifts to renewable energy, the demand for power electronics and sensors is projected to skyrocket, and Applied provides the equipment to make those very components.
This materiality matrix brilliantly illustrates the balancing act I mentioned earlier. It shows exactly how they weigh internal priorities against stakeholder expectations. You can see them actively balancing this need for rapid breakneck innovation against critical priorities like climate change, greenhouse gas emissions, employee safety, and supply chain resilience. Running a modern, globally crucial company is incredibly complex. Every single decision has to be weighed against competing priorities. And speaking of employee safety, check out this number, 0.41. That is their total case incident rate for workplace injuries in fiscal 2024. Why does that matter to us? Because the industry benchmark is 0.60. They are significantly outperforming the average. It proves that even while they are scaling up like crazy to meet the AI demand, they aren't letting safety slip. They're proving that high growth doesn't have to come at the expense of the people working on the floor.
Let's wrap things up with Section 5, the road to 2027. Thanks to this absolutely accelerating demand for logic, DRAM, and advanced packaging, all driven by AI, they are projecting an incredible 30% growth in their semiconductor equipment business for calendar year 2026 alone. 30%. That is a massive operational scale-up. It reflects a deep fundamental confidence that this AI infrastructure build-out is not just a flash in the pan. It's a permanent, foundational shift in global technology hardware.
But all of this immense scale brings us to a really crucial question I want to leave you with today. As global AI scales exponentially, can semiconductor equipment manufacturers actually keep up this incredible pace of innovation while still hitting their net zero goals? It's going to be a monumental balancing act between fueling this AI gold rush and protecting the planet. We'll definitely be watching to see how the industry tackles this dual challenge over the next decade. Thanks for joining me on this explainer, and keep your eye on the engine inside the engine.